beloved seekers of wisdom, dear family of builders and truth seekers. There is a question that echoes through the minds of millions who watch the wealthy accumulate more while feeling left behind themselves. A question born not of envy, but of genuine confusion and desperate hope. What do they know that I don't? What investments are they making that I'm missing? What's the secret that turns small amounts into fortunes? And buried within that question is a deeper truth, a truth that will either liberate you or leave you chasing shadows for the rest of your life. The answer is not what you think. And understanding this, truly understanding this, will change everything about how you build wealth. Let me tell you something that will disturb you at first, but ultimately set you free. There are no magic investments, no secret stocks, no hidden opportunities that will reliably 10x your money in 2 years. Anyone promising you such things is either delusional or dishonest, and I refuse to be either. But, and this is crucial, there are 5 principles of investment, 5 fundamental truths about how wealth is actually built, that have transformed modest savings into substantial fortunes countless times throughout history. Not through luck, not through perfect timing, but through understanding what investment actually means. These 5 principles are not exciting. They're not new. They're not secrets that only the wealthy know. They're in plain sight, always have been. But most people ignore them because they're not glamorous enough, not fast enough, not thrilling enough, and so people stay poor. Not because they lack opportunity, but because they're looking for the wrong things in the wrong places with the wrong time frame. Let me tell you about a man I knew many years ago. We'll call him Edward. Edward was 34 years old in 1974. He worked as an accountant, made $18,000 a year, decent money at the time, but nothing spectacular. He'd managed to save $3,000 an hour, about 3 months of his salary. Edward came to me asking for investment advice. He'd heard stories about people making fortunes in the stock market. He wanted to know which stocks to buy, which opportunities would make him rich quickly. I've been reading about these new technology companies, he said. Computers. People say they're the future. Should I put everything into tech stocks? I asked him a simple question. Why do you want to invest? He looked at me like I was crazy. To make money, obviously. To get rich. No, I said. That's not why you invest. That's a consequence, not a purpose. Why do you actually want money? Edward thought about it, really thought, and then he said something honest. I want to not worry. I want to know that I'll be okay when I'm older. I want to be able to help my kids someday. I want security. Then you're not looking for investments that will make you rich quickly. I told him, you're looking for principles that will make you secure slowly. There's a profound difference. Edward was disappointed. Like most people, he'd hoped I would give him a list of stocks, a roadmap to quick wealth. But I gave him something more valuable. I gave him 5 principles. And I told him, follow these 5 principles for the next 20 years. Don't deviate. Don't get distracted by the next hot thing. Don't try to get clever. Just follow the principles. Edward followed them. Not perfectly. Nobody does. But consistently, patiently. When Edward retired at 65, he had $2.4 million from 3,000 hours in starting capital and a modest accountant's salary. Not through luck, not through picking miracle stocks. Through principles applied consistently over time. This is what I want you to understand. The question is not, what investments will 10x my money by 2026? The question is, what principles of investment will compound my wealth over decades? Let me share with you the 5 principles that transformed Edward's life and have transformed countless lives before and since. Not investments, principles. The difference is everything. TGFRNCIPLE. Invest in your earning power first. The single most powerful investment most people can make has nothing to do with the stock market. It has nothing to do with real estate or cryptocurrency or any asset class you can name. It's investing in your ability to earn money, your skills, your capabilities, your value in the marketplace. Let me tell you why this is the foundation of everything else. If you have a $10,000 to invest and you put it in the stock market at average returns, you might have a $20,000 in 10 years, maybe $30, and if you're lucky and the market is strong. That's compound interest working slowly but surely. But if you take that same $10,000 and invest it in learning a high-value skill, if you use it to get certifications or training that doubles your annual income from $50,000 to $100,000, You've just created an additional to $50,000 in annual income every single year for the rest of your career. Over 10 years, that's $500,000 in additional income, not from market returns, from your increased earning power. This is not theoretical. This is the single most reliable path to substantial wealth that exists. Let me tell you about a young woman I met recently. Her name is Rachel. Rachel was 28 years old, working in customer service, making $42,000 a year. She had $8,000 in savings and was trying to figure out how to invest it wisely. Most financial advisors would have told her to open a brokerage account, buy some index funds, start dollar cost averaging. All perfectly reasonable advice for money you don't need for other purposes. But I asked Rachel the same question I asked Edward. What's your current earning power, and could you increase it dramatically with education or training? Rachel thought about it. I've always been good with people, she said. I solve problems all day, but I don't have any specialized skills, just customer service. What problems do businesses have that they pay a lot of money to solve? I asked. She didn't know. So we researched together, and we discovered something interesting. Companies were desperately seeking people who could manage customer success, not just answer support tickets, but proactively ensure customers got value from products and stayed subscribed. It was a specialized skill. It required understanding data, customer psychology, software systems, and business metrics, and it paid $70,000 to $95,000 for people with just a few years of experience. Rachel made a decision. She took $3,000 of her $8,000 savings and invested it in an intensive 12-week online program teaching customer success management. She studied obsessively while still working her full-time job. 4 months later, Rachel landed a customer success position at a software company. Starting salary, $72,000, a $30,000 increase. Within 2 years, she was making $95,000. Within 4 years, $125,000. That $3,000 investment didn't just grow to $6,000 through market returns. It grew into $83,000 in additional annual income compared to where she started. Over a career. That's literally millions of dollars in additional lifetime earnings. This is the first principle. Before you invest in assets, invest in your ability to generate income. Because income is the fuel that feeds all other investments. Most people have this backwards. They try to invest their way to wealth while their income stays stagnant. They're trying to fill a bucket with a teaspoon while ignoring that they could upgrade to a fire hose. The wealthy understand this instinctively. They invest heavily in education, skills, certifications, relationships, anything that increases their earning power. Then they use that amplified income to acquire assets. The poor and middle class skip the first step. They try to invest modest incomes into assets and wonder why wealth accumulates so slowly. TS code CIPLE, invest in ownership, not speculation. There's a fundamental difference between owning assets that produce value and speculating on assets that might increase in price. Most people confuse the two. This confusion costs them dearly. Let me explain the difference. When you buy stock in a company that produces goods or services, generates profits, and returns value to shareholders through dividends or buybacks, you're an owner. You own a piece of a productive enterprise. Your returns come from the value that enterprise creates. When you buy cryptocurrency hoping someone will pay more for it tomorrow, you're a speculator. Your returns depend entirely on someone else's willingness to pay a higher price. No value is being created. Only prices are changing. The first is investing. The second is gambling dressed up as investing. Now, I'm not saying speculation never works. Some people make money speculating. But speculation is not the foundation of lasting wealth. It's too unreliable, too dependent on timing and luck, too easy to lose everything. Ownership, real ownership of productive assets, that's the foundation of generational wealth. Always has been. Always will be. Let me tell you about two brothers who illustrate this perfectly. Michael and Stephen. Both were 35 years old in 2015. Both had $50,000 to invest. Both wanted to grow their money substantially. Michael, the older brother, was fascinated by cryptocurrency. He'd been reading about Bitcoin, about how early investors had made millions, about how blockchain was going to revolutionize everything. He put his entire $50,000 into various cryptocurrencies. Bitcoin, Ethereum, a dozen smaller coins he'd heard about on forums and YouTube. Stephen, the younger brother, was more conservative. He bought index funds. Boring, broad market index funds that owned pieces of thousands of productive companies. Companies that made products, employed people. generated profits. For a while, Michael looked like a genius. By late 2017, his 50,000 had grown to nearly 300,000. He felt vindicated. He mocked his brother for being too cautious, for missing out on the revolution. Stephen's 50,000 had grown to about 65,000. Solid returns, but nothing compared to Michael's spectacular gains. Then 2018 happened. The cryptocurrency market crashed. Michael's 300,000 portfolio collapsed to 80,000. He held on believing it would recover. It dropped further to 45,000. He'd ridden it all the way up and all the way back down. Meanwhile, Stephen's portfolio had a modest correction, but continued its steady growth. By 2024, Stephen's original 50,000 investment had grown to approximately 140,000, and not through dramatic gains, through the steady, compounding growth of productive businesses increasing in value year after year. Michael's portfolio, it's still around 60,000. He made and lost a fortune. Stephen built one slowly and kept it. This is the second principle: invest in ownership of productive assets, not speculation on price movements. Productive assets are businesses, real estate that generates rental income, farmland, infrastructure, things that create value independent of what someone might pay for them tomorrow. Speculation is buying something only because you think the price will go up. That's not investing, that's gambling. And while some people win at gambling, it's not a foundation for building wealth. The wealthy own businesses. They own real estate that produces income. They own stakes in productive enterprises. The speculators, they chase prices, and most of them lose. THIRD/NCPL invest for decades, not years. There's a mathematical reality that most people don't grasp. Compound growth is almost invisible in the early years and almost magical in the later years. This is why most people quit too early. They invest for 3 years, see modest results, and think, this isn't working. They don't understand that they quit right before the magic starts. Let me show you what I mean with actual numbers. You invest in 10% annual returns after 1 year to 11,000, gain 1,000 after 5 years, a 16th, 105, gain 6,005 after 10 years, 937 after 20 years, 67 to gain a 57, 275 after 30 years to 134, you 494 is a gain 164, 49. Notice what happens. In the first decade, you gained a 15,937. In the second decade, you gained 41,338. In the third decade, you gained 107,299. Same annual return, same strategy, but exponentially different results based purely on time. The gains in year 30 are almost 10 times larger than the gains in year 5. Not because you did anything different, just because compound growth is exponential, not linear. This is why time is the most valuable asset in investing. Not intelligence, not perfect timing, not picking the right stocks, time. Patient, boring, uneventful time. Let me tell you about a woman named Margaret who understood this at a level most people never reach. Margaret started investing at age 25. She had a simple job as a librarian making 35 hours in a year. She invested $200 a month, about 7% of her income, into a basic index fund. Every year, she got modest raises. Every year, she increased her contribution slightly to match her income growth. But she never changed her strategy, never tried to time the market, never chased hot stocks. Just steady, boring, consistent investing. Her friends thought she was wasting her youth. You're only young once, they'd say. Live a little. You can save when you're older and making more money. But Margaret understood something they didn't. She understood that the years between 25 and 35 were worth far more than the years between 55 and 65. Not because she'd contribute more money, but because those early dollars would have decades to compound. By age 35, Margaret had accumulated approximately $38,000 in her account. She'd contributed roughly $26,000 and earned about $12,000 in returns. Decent, but not life-changing. Her friends were buying nicer cars and taking better vacations. She sometimes wondered if she was missing out, but she didn't stop. She kept investing. Same strategy, same patience, same boring consistency. By age 45, her account had grown $135,000. Now the compound growth was becoming more visible. The returns in a single good year were larger than her annual contributions. By age 55, $380,000. The account was growing by $30,000 to $40,000 in some years just from returns. More than her annual contributions. By age 65, when Margaret retired, her account was worth $1.1 million. From $200 a month, from a librarian's salary. From 4 decades of patient, consistent investing. Her friends who told her to live a little. Most of them were still working, still worried about money, still hoping Social Security would be enough. Margaret retired comfortably, not because she was smarter, not because she earned more, but because she understood the third principle. Invest for decades, not years. Give compound growth enough time to work its exponential magic. This principle requires something most people don't have: the ability to delay gratification for periods measured in decades. The ability to do something consistently when you see no immediate benefit. The ability to trust mathematics over emotions. Most people cannot do this. They invest for 3 years, and when they don't see dramatic results, they quit, or they change strategies, or they chase the next hot thing. They're like someone who plants an oak tree, waters it for 2 years, sees it's only 4 feet tall, and cuts it down because it's not working, not understanding that oak trees take decades to reach full size. But when they do, they're magnificent. The same is true for investing. The early years feel pointless. The middle years feel slow. Only the later years feel magical. But you only get to the later years by enduring the early and middle years. This is why young people have the most valuable asset of all for investing: time, not money, not intelligence, not connections, time. And most of them waste it because they can't see results quickly enough. Teach Fuyuch Principle, invest automatically. Remove decisions. Here's a truth that most people don't want to hear. You cannot trust yourself to make good investment decisions consistently over decades. Not because you're stupid, but because you're human. And humans are wired with cognitive biases that destroy investment returns. We panic when markets crash. We get greedy when markets soar. We chase past performance. We sell winners too early and hold losers too long. We're influenced by news, by friends, by emotions, by our own narratives about what's happening. Study after study shows that the average investor dramatically underperforms the market, not because they pick bad investments, but because they make bad decisions about when to buy and sell. The solution: remove the decisions, automate the process, invest the same amount at the same time every month regardless of what's happening in the market. This is called dollar cost averaging, but that phrase makes it sound more complicated than it is. It's simple: same amount, same day, every month, forever. No thinking, no deciding, no reacting to news or emotions. Let me tell you about a man named Thomas who learned this lesson the hard way. Thomas started investing in 2005. He was 30 years old. He'd read books about investing. He understood the basics. He opened a brokerage account and started buying index funds. But Thomas made one crucial mistake. He tried to be smart about it. He tried to time the market. When the market was going up in 2006 and 2007, Thomas thought it looked too expensive. "I'll wait for a correction," he told himself. He kept his money in cash, waiting for better prices. Then 2008 happened. The market crashed. Prices fell 40%. Thomas was excited. Finally, stocks are cheap, but he hesitated. What if they fall further? He waited. The market bottomed in March 2009 and started recovering. Thomas watched it climb 10%, 20%, 30%. "I missed it," he thought. "I should have bought at the bottom." But he still didn't invest because now it seemed like he'd missed the opportunity. By 2010, the market had recovered most of its losses. Thomas finally invested, thinking he'd learned his lesson. Then 2011 had a correction. Thomas panicked and sold. "I don't want to lose what I gained," he rationalized. You see the pattern. For 6 years, Thomas tried to be smart about timing. And in those 6 years, he'd made almost nothing while the market had essentially recovered from the financial crisis. His friend Daniel, on the other hand, had invested $500 every single month starting in 2005, through the boom, through the crash, through the recovery. He never stopped, never paused, never tried to time anything. Daniel had contributed $60,000 and his portfolio was worth approximately $78,000. Not spectacular, but solid growth despite living through one of the worst financial crises in history. Thomas had contributed maybe $20,000 total through his sporadic, poorly timed investments. His portfolio was worth about $22,000. He'd barely broken even despite a decade of trying to be clever. This is the fourth principle: invest automatically. Remove your ability to make emotional decisions. Set up a system where money goes from your paycheck directly into investments before you ever see it. Then ignore everything else. No watching CNBC, no reading market predictions. No reacting to crashes or booms. Just automated, consistent investing regardless of what's happening. This sounds boring. It is boring. But boring is what works. Exciting is what destroys returns. The wealthy understand this. That's why they use trusts, automatic investment plans, and advisors who prevent them from making emotional decisions. They don't try to be smart about timing. They try to remove timing from the equation entirely. The 50H pray and CIPLE. Invest in what you understand deeply. Here's the final principle, and it's the one most people violate most egregiously. They invest in things they don't understand because someone told them it was a good opportunity. Cryptocurrency, options, penny stocks, complex real estate syndications, private equity deals, NFTs, whatever the current trend is. And when these investments go bad, and they often do, these people have no framework for understanding what went wrong or how to avoid it in the future. Let me be very clear. You should only invest in things you understand well enough to explain to a 12-year-old. If you can't explain how it makes money, where the returns come from, what the risks are, you shouldn't be investing in it. This doesn't mean you can't invest in the stock market if you don't understand every company. It means you should understand the basic mechanism companies make products, sell them at a profit, and return value to shareholders. That's investable. But if someone is pitching you a revolutionary investment with guaranteed returns that you don't fully understand, that's not investing. That's hoping. And hope is not a strategy. Let me tell you about a man named Richard who violated this principle catastrophically. Richard was 45 years old, a dentist, made good money, had accumulated about 200,000 in savings over his career. He'd been conservative, mostly keeping it in savings accounts and CDs, earning very little. Then a friend told him about an amazing opportunity, a real estate development deal in another state, commercial properties. The friend's brother-in-law was the developer, promised 18% annual returns, far better than the 1% Richard was getting from his savings account. It's a sure thing, the friend said. My brother-in-law has done dozens of these, never lost money. Richard didn't understand real estate development, didn't understand how commercial properties worked, didn't understand the market in that state, didn't understand the financial structure of the deal. But 18% sounded amazing, and his friend seemed trustworthy. So Richard invested $150,000, 75% of his life savings, into something he didn't understand. For the first year, he received checks, small returns, maybe 5% total. Not the promised 18%, but something. He felt validated. Year 2, the checks stopped. The developer had run into temporary cash flow issues. But don't worry, he'd resume payments soon. Year 3, Richard learned the development had failed. The developer had used his money to pay earlier investors, a Ponzi scheme disguised as a real estate deal. The developer declared bankruptcy. Richard would recover maybe 10 cents on the dollar if he was lucky. The $150 gone. Because Richard invested in something he didn't understand, based on a promise that sounded too good to be true. Compare this to Richard's colleague, Dr. Sarah. Same age, same profession, similar savings. But Sarah followed the 5th principle religiously. Sarah only invested in simple index funds tracking the U.S. stock market. She understood this: investment companies make products, earn profits, grow over time. Simple, boring, understandable. She never chased high returns, never invested in complex schemes, never trusted friends' hot tips. Just boring index funds earning average market returns. 20 years later, Sarah's boring strategy had turned her savings into 1.8 million. Average returns. No genius. Just consistent investment in things she understood. Richard, if he'd stayed with his conservative savings instead of chasing 18% returns, would have had maybe $250. Not as good as Sarah, but not a catastrophic loss. This is the 5th principle: only invest in what you deeply understand. And if you don't understand something, either learn it thoroughly or don't invest in it. There are no exceptions to this rule. The wealthy follow this principle religiously. They invest in businesses they understand, industries they know, structures they can explain. They turn down opportunities constantly because they don't meet this criterion. The poor and middle class violate this principle constantly. They chase returns without understanding risk. They invest in trends without understanding fundamentals. They trust promoters without understanding mechanics. And they lose money, over and over again, not because they're unlucky, but because they violated the fundamental principle of only investing in what you understand. Now let me bring all 5 principles together and show you what they create when combined. Imagine someone who follows all 5 principles consistently. They invest heavily in their earning power, going from $45,000 annually to $995,000 over a decade through strategic skill development. That's the first principle. They invest that increased income into ownership of productive businesses through broad index funds, not speculation on price movements. That's the second principle. They invest for 40 years from age 25 to 65, giving compound growth maximum time to work. That's the third principle. They invest automatically, $100,000 per month, increasing slightly each year, regardless of market conditions. That's the fourth principle. They invest only in simple, understandable index funds, never chasing complex opportunities they don't understand. That's the fifth principle. What's the result? At reasonable historical market returns of 8 to 10%, this person retires with approximately $3 to $4 million, not from inheritance, not from luck, not from picking miracle stocks or perfect timing, from principles applied consistently over decades. This is not exciting. It's not a story that makes for good headlines. There's no drama, no risk of ruin, no spectacular wins, just steady, boring, reliable wealth building, which is exactly how almost all lasting wealth is actually built. But here's what people struggle with. Here's why most people never apply these 5 principles even after learning them, even after seeing the math, even after hearing the stories. It's not because the principles don't work. It's because following them requires something most people simply cannot sustain. Let me tell you about the real enemy of wealth building. It's not lack of knowledge, it's not lack of opportunity, it's not even lack of money to invest. The real enemy is impatience combined with social comparison. These two forces, working together, destroy more financial futures than any market crash or economic recession ever could. Let me explain what I mean. When you follow these 5 principles, especially in the early years, your life will look unremarkable. While friends are buying new cars, you're driving a 10-year-old sedan. While colleagues are taking European vacations, you're camping locally. While neighbors are living in impressive houses, you're in a modest apartment or starter home. Not because you can't afford better, but because you've made a conscious choice to invest in assets that compound rather than consume on things that depreciate. This choice requires you to tolerate looking less successful than you actually are, to appear ordinary while building something extraordinary, to be comfortable being underestimated. Most people cannot do this. The psychological pressure is too intense. The social judgment is too painful. The comparison is too corrosive. Let me tell you about 2 couples who illustrate this perfectly. Both couples were in their early 30s. Both had similar household incomes, around $140,000 annually. Both were intelligent, hardworking people. The first couple, let's call them David and Jennifer, decided to follow the 5 principles. They lived in a modest townhouse even though they could qualify for a much larger home. They drove reliable but unimpressive cars. They took inexpensive vacations. They automated investing 30% of their income. Their friends thought they were either struggling financially or excessively cheap. Neither was true. They were simply investing aggressively while their friends were consuming aggressively. The second couple, Robert and Michelle, made different choices. They bought a beautiful house in an upscale neighborhood, new cars, designer furniture, annual trips to resort destinations. They looked successful. They felt successful. They were also saving almost nothing, living paycheck to paycheck at $140,000 a year. One financial shock away from crisis. Fast forward 20 years. David and Jennifer, now in their early 50s, have a paid-off modest home, 2 paid-off cars, and $1.9 million in investments. They're financially independent. They could retire tomorrow if they chose to. Robert and Michelle have a house they still owe $300,000 on car payments, credit card debt, and maybe $120,000 in retirement savings. They look successful. But they're trapped. One job loss would be catastrophic. Retirement seems impossibly distant. Here's what kills me about this story. Robert and Michelle are not bad people. They're not stupid or reckless. They're not living wildly beyond their means by societal standards. They're just normal. They're doing what normal people do, living a lifestyle that matches their income, enjoying the present, trusting that somehow, eventually, things will work out financially. And that normalcy, that doing what everyone else does, it's costing them their freedom, their security, their future. David and Jennifer look normal too, but they're not normal. They made abnormal choices. They chose future freedom over present appearance. They chose long-term compound growth over short-term social validation. And that abnormality, that willingness to be different, bought them something Robert and Michelle will never have: options. The ability to choose. Freedom from financial fear. This is what I mean when I say the real enemy is impatience combined with social comparison. You can intellectually understand the 5 principles. You can see the math. You can believe they work. But if you cannot tolerate looking ordinary while building extraordinary wealth, if you cannot resist the pressure to keep up with peers, if you cannot delay gratification for periods measured in decades, you will fail. Not because the principles don't work, but because you won't apply them long enough for them to work. Let me tell you what helped David and Jennifer succeed where most people fail. It wasn't superhuman willpower. It wasn't genetic advantage. It was one simple psychological trick. They stopped comparing themselves to their peers, completely, deliberately. They recognized that most of their peers were on a path to financial mediocrity, so matching their peers meant accepting mediocrity. Instead, they compared themselves only to their past selves. Are we better off this year than last year? Are we progressing toward our goals? Are we building what we want to build? The answer was always yes, and that was enough. They didn't need anyone else's validation. They didn't need to impress neighbors. They didn't need to signal success through consumption. They were internally motivated rather than externally validated. And that internal motivation sustained them through 2 decades of living below their means while building wealth above their peers' reach. This is perhaps the most important lesson I can share. If you're going to follow the 5 principles successfully, you must develop psychological independence from social pressure. You must build your sense of self-worth from something other than what you own or how you look to others. Because the path to substantial wealth through these principles requires you to look unimpressive for years, maybe decades. And if you cannot tolerate that, if you need external validation, you will break. You will abandon the principles. You will join the 95% who work their entire lives and retire with almost nothing. Now let me address something that might be troubling you. You might be thinking, this all sounds good, but I'm already 45 or 50 or 55. I don't have 40 years. These principles won't work for me. Let me tell you about a man named George who thought exactly that. George was 52 years old when he finally woke up to his financial reality. He'd spent decades earning good money as an engineer, but saving almost nothing. He had maybe 40,000 in retirement accounts. He was terrified. It's too late for me, he told me. These compound growth principles require decades. I don't have decades. I have maybe 15 working years left. I asked him a simple question. Do you think you'll live past 67? I hope so. My parents lived into their 80s. Then you have at least 15 years, probably 30. The principles still apply. They just need to be applied more aggressively. George didn't want to hear this. He wanted a miracle, a way to catch up quickly, a shortcut that would compensate for lost decades. But there are no shortcuts. There are only choices. George could spend his remaining working years making the same choices that left him with 40,000 at 52. Or he could make different choices and see where they lead. He chose differently. Here's what George did. First principle. He invested heavily in his earning power. He got a specialized certification in his field that increased his income from 95,000 to 135,000. That's an extra 40,000 annually. Second principle. He invested exclusively in low-cost index funds. Boring, simple, understandable ownership of productive businesses. Third principle, he committed to 15 years of aggressive investing, recognizing that even 15 years allows meaningful compound growth. Fourth principle, he automated everything. 40% of his income went directly from paycheck to investments. He lived on the remaining 60%, which was still more than he'd had before his raise. Fifth principle, he never deviated, never chased opportunities, never tried to time the market, just consistent investment in what he understood. George is now 67. 15 years have passed. His 40,000 has grown to approximately 85,000. Not from the initial investment growing, though, that helped. Primarily from 15 years of aggressive contributions compounding over time. Is 580,000 enough for a comfortable retirement? That depends on lifestyle and expectations. But it's a hell of a lot better than the 40,000 he would have had if he decided it was too late. and given up. This is the truth about late starts. You'll never have as much as someone who started early. The mathematics don't lie. Starting at 25 beats starting at 52. Always. But starting at 52 beats never starting at all. And starting at 60 beats starting at 65. The best time to plant a tree was 20 years ago. The second best time is today. This applies to oak trees and to investment portfolios. So if you're reading this and thinking, I'm too old, I've missed my chance, you're wrong. You've missed the chance to have started earlier. You haven't missed the chance to start now. And starting now, with whatever time remains, is infinitely better than continuing to do nothing. Now let me tell you the most profound thing I've learned about these 5 principles after watching people apply them, or fail to apply them for decades. The principles themselves are simple. Anyone can understand them. Most people do understand them intellectually. But understanding is not the same as internalizing, and internalizing is not the same as applying consistently over decades. The real journey is not learning the principles. It's becoming the kind of person who can apply them despite every psychological force pushing against you. It's becoming someone who can delay gratification for periods measured in decades. Someone who can ignore social pressure and comparison. Someone who can trust mathematics over emotions. Someone who can be patient in an instant gratification world. This transformation of character, this development of financial temperament, this is harder than learning any investment strategy. And it's more valuable, because once you've developed this temperament, wealth becomes almost inevitable, not through any particular brilliance, just through the patient application of principles that compound over time. Let me tell you about the moment I understood this deeply. I was watching 2 people I'd known for years. Both had received the same advice. Both understood the 5 principles. Both acknowledged they were true. Both intended to follow them. 5 years later, one had transformed their financial life. The other was in exactly the same place. The difference: one had developed the temperament to actually do the boring, unglamorous work consistently. The other kept intending to start, kept planning to commit, kept waiting for perfect conditions. Intention without action is fantasy. Understanding without application is useless. The 5 principles only work if you actually follow them. Not once, not when you feel motivated, but consistently, month after month, year after year, decade after decade. And most people cannot sustain that, not because they don't want to, but because they've never developed the psychological capacity for long-term, delayed gratification in a world optimized for instant pleasure. So here's my final challenge to you. Don't ask what investments will 10x my money. Ask instead, am I the kind of person who can follow proven principles consistently for decades despite seeing no immediate results? If the answer is no, if you're honest with yourself and recognize you don't have that temperament yet, then your first investment isn't money into the market. It's effort into developing that temperament, into becoming someone capable of patience, of delayed gratification, of ignoring social pressure. Because that person, that version of you with the right temperament will build wealth almost automatically. Not through brilliance, just through consistency applied to proven principles over time. And that person is achievable. Not overnight, not easily, but achievable through daily choices about who you're becoming. Beloved family of builders and seekers, we've reached the moment of truth. You came to this video hoping for a list of investments, 5 stocks, 5 opportunities, 5 secrets that would transform your modest savings into substantial wealth by 2026. And I've told you something harder to hear, but far more valuable. There are no such investments. There are only principles. And those principles won't make you wealthy by 2026. They'll make you wealthy by 2045 or 2050. If you apply them, if you sustain them, if you become the kind of person capable of following them. This is not what you wanted to hear. I know that. You wanted shortcuts, magic, a path that wouldn't require decades of patience and discipline. But I care about you too much to lie to you. And the truth is this: the 5 principles I've shared, investing in earning power, investing in ownership, investing for decades, investing automatically, investing only in what you understand, these are the only reliable path to substantial wealth that exists. Not glamorous, not exciting, not quick, but real. Proven. Available to anyone willing to apply them. And here's what I want you to understand at the deepest level. The question is not whether these principles work. They do. The evidence is overwhelming. The mathematics are irrefutable. Millions of people have built substantial wealth through these exact principles. The question is whether you can become the kind of person who applies them consistently for decades. Whether you can develop the temperament that wealth building requires. Whether you can resist the social pressure, the impatience, the desire for instant results. That's the real journey. Not finding the right investments, but becoming the right investor. Not discovering secret opportunities, but developing patient discipline. Let me tell you what I hope for you as we close this conversation. I hope you stop looking for shortcuts. Stop searching for the investment that will change everything quickly. Stop believing that somewhere out there is a secret that will make wealth easy. There is no such secret. There is no such shortcut. There is only the patient, disciplined application of principles that have worked for generations and will continue working for generations to come. I hope you make peace with the fact that building substantial wealth takes decades. Not because the universe is cruel, but because compound growth is exponential and exponential growth requires time to become meaningful. I hope you develop the courage to live below your means even when you could afford more, to drive the modest car, to live in the smaller house, to take the inexpensive vacation, not forever, but for the decades it takes to build a foundation that will support whatever life you want in the future. I hope you build your self-worth from something other than what you own or how you appear to others, that you find your sense of identity in who you're becoming rather than what you're consuming, that you develop the psychological independence to walk your own path even when everyone around you is walking a different one. I hope you start today. Right now, not with perfect conditions, not with complete certainty, not with all the money you wish you had, but with whatever you have, wherever you are, however old you are, because every day you delay is a day of compound growth you'll never recover. Every month you spend waiting for perfect timing is a month that cannot be reclaimed. Every year you spend intending to start, but not starting is a year stolen from your future self. The 5 principles are waiting. They've always been waiting. They'll work for anyone willing to apply them. The question has never been whether the principles work. The question has always been whether you'll do the work. And that question, that profound life-determining question, only you can answer. I've given you the map. The path is clear. The destination is proven. But I cannot walk the path for you. I cannot make you patient when you feel impatient. I cannot make you disciplined when you feel tempted. I cannot make you consistent when you feel like quitting. That's your work, your journey, your transformation from someone who wants wealth to someone who builds wealth. And here's what I want you to know. You're capable of this transformation, not because you're special or gifted or lucky, but because the capability to delay gratification, to follow proven principles, to resist social pressure, these are learnable skills. Character traits you can develop through daily practice. Every time you choose to invest instead of spend, you're developing that character. Every time you automate another contribution, you're building that discipline. Every time you ignore market noise and stick to your plan, you're strengthening that temperament. You're not just building wealth. You're building yourself into someone capable of building wealth. And that person, that version of you with the right temperament and discipline, is worth more than any investment portfolio. Because that person can build wealth in any economy, can recover from any setback, can create security through sheer consistency and patience. That person is free, not because they have a certain number in their bank account, but because they've developed the capabilities that make financial security inevitable. Become that person, starting today, with whatever small step you can take right now. Maybe it's opening an investment account. Maybe it's automating your first 100 monthly contribution. Maybe it's signing up for a course that will increase your earning power. Maybe it's just committing in your heart to follow the 5 principles for the next decade regardless of what happens. Whatever that first step is, take it. Then take another tomorrow and another the day after. Not dramatically, not perfectly, just consistently. One small step after another, compounding into a journey that transforms your financial life. 20 years from now, you'll look back on this moment, this exact moment when you heard these principles and faced a choice. And you'll either think, that's when everything changed. That's when I stopped looking for shortcuts and started following principles. That's when I became the person I needed to be. Or you'll think, I wish I'd started then. I understood it. I knew what to do. But I kept waiting, kept looking for something easier, kept hoping for a miracle instead of doing the work. The difference between these two futures is being decided right now, through what you do in the days and weeks following this conversation, through whether you apply what you've learned or just file it away as interesting information. I cannot make this choice for you, but I can tell you with absolute certainty, the path of principles leads to security, freedom, and peace. The path of shortcuts leads to disappointment, anxiety, and regret, every time, without exception. Choose principles, choose patience, choose consistency, choose delayed gratification. Choose the harder path that leads to the better destination. And when you're tempted to quit, and you will be tempted, remember this, the principles don't stop working just because you stop seeing immediate results. Compound growth continues in silence, in darkness, invisible to those without patience. But it continues. Trust the mathematics, trust the principles, trust the process, and most importantly, trust yourself to become the kind of person who can sustain the process long enough for the magic to happen. The wealth you seek is not in some secret investment. It's on the other side of a transformation from who you are today to who you need to become, a transformation from someone who wants results to someone who does the work. That transformation is available to you right now, this moment, through a simple decision to start, to commit, to follow principles proven across generations. Make that decision, then honor it through daily action, and watch as the compound effect of principled behavior over time creates wealth that seemed impossible when you started. You don't need a miracle investment. You need to become a principled investor. Make that your focus. Make that your goal. Make that your commitment. The 5 principles are your foundation. Build on them, patiently, consistently, for decades. And when you reach financial freedom, and you will if you follow this path, remember that the real achievement wasn't the wealth you accumulated. It was the person you became in the process of accumulating it. That person, disciplined, patient, immune to social pressure, capable of delayed gratification, that person is the real wealth. The money is just evidence that you built something valuable, a character capable of building wealth. Go now, begin, not tomorrow, not when conditions are perfect, not when you feel ready. Now, the 5 principles are waiting. Your future self is waiting. Your financial freedom is waiting. All that's required is that you start and keep going. No matter what, that's the secret. That's the whole secret. Start and never stop. Now go build something worth having and become someone worth being. The rest will follow. I promise you it will follow.